Now, the government's announcement last week on goods and services tax cuts has received only a lukewarm reaction from Indian stocks. The tax cuts were aimed at boosting consumption. However, market reaction suggests the benefits will only be marginal and restricted to a few sectors at best. After the GST reforms announcement, bets were for Indian stocks to gain significantly. However, trading trends this week have barely moved the needle on gains. The blue chip Sensex index and the broader Nifty index closed slightly in the green on Monday, with the trend on Tuesday showing a similar pattern. Gains were capped by a sell-off in tech stocks on reports showing concerns around potential U.S. outsourcing taxes. However, a deep dive into sectoral stocks showed auto and metal shares supported GST reforms optimism. The highlight of the GST reforms is the removal of cess. Now, previously, a composition cess ranging between 1% and 22% was levied on cars based on their category or drivetrain. This caused the effective tax to range between 29 to 50%. After September 22nd, GST on small cars will be 18%. Now, auto stocks outperformed with sector index up 1.8%. Now, that was powered by a rise in Tata Motors and Mahindra stocks. Both stocks jumped 4% after cutting prices across their lineups to pass along the full benefit of the GST reductions to buyers. 6 of the top 88 Nifty gainers were from the auto sector. Now, U.S. tariffs and foreign outflows have pushed Indian stocks to underperform emerging market peers this year. Last week, equity bulls were betting that Indian stocks would close the gap with peers. So far this year, Indian benchmark Nifty has risen 4.6% compared to a 19% surge in the MSCI Emerging Markets Index. The underperformance has come as global funds have withdrawn a net $16 billion from Indian shares in 2025.